Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He covers the oil and natural gas markets extensively. We're recording this interview on Wednesday, September 11th, 2024. The West Texas Intermediate oil price, it's down substantially at the bottom end of a trading range. It's down to $67.31. The natural gas price has been in a bear market lately for the last 9 to 10 months. It rallied a little bit over the last 4 or 5 months briefly. It's still down around $2.27 when we're recording this interview. He runs the Energy Prospectus Group out of Houston, Texas, and he's the former senior executive at Hess Oil. Dan Steffens, thank you for joining me again.
Yeah, thanks for having me. We live in interesting times, my friend.
Lots of crazy stuff. Let's focus mostly on oil and energy right now because that's your expertise, and I want to benefit my listeners to benefit from your expertise, which is what I try to do with all my interview guests. I try to draw out their expertise in the questions. So normally, Dan, with the summer driving season, seasonality for oil and natural gas demand, especially for like gasoline, jet fuel, boat fuel, people are using diesel, taking the boat out during the summer. Isn't the demand for the transportation fuels very high the last first summer, or why do you think then the oil price is weak now compared to the past seasonality?
Yeah, there's more demand for oil-based transportation fuels in the summer, and once you get past Labor Day, they kind of drop off a bit. The kids are back in school and all, but it also takes more black oil, crude oil, to make summer blend gasolines. That's what some people don't realize, and we're still going to be using summer blend gasolines for a while, but that's just part of the reason the prices come down. The other thing is OPEC came out a week or so ago, and they said they were going to start increasing or reduce their quotas and add another 180,000 barrels a day of production, which 180,000 barrels a day in a world that consumes 105 million barrels a day is a drop in the bucket. So it wasn't that big of a deal. It was just kind of an agreement that some of the smaller countries in OPEC were whining about getting, their quotas lifted, so they were going to give it to them. But then when the oil price dropped on that announcement, a few days later, they announced, okay, we're not going to do it October 1st. We're going to push that back to December 1st. And you would have thought that the oil price would have bounced back. But I personally believe that there are forces at work trying to get the oil price down for a while because they desperately want the Fed to start lowering interest rates. And if they can get, transportation fuels are a big part of inflation. So if they can do their part to reduce inflation a little bit, maybe they can get the Fed to, lower the interest rate by 50 basis points versus 25 basis points. I don't know. But that's kind of one thing. And then also there's this concern about the Chinese economy is not using as much oil as it is. But I'll tell you, the data is showing us that India's increased demand for oil is almost offsetting any of the decline that they were expecting in demand growth in China. And China's demand isn't going down. It's just not growing as fast as they had originally predicted.
Well, they tried to switch to electric vehicles for taxis in a lot of the major cities, but I'm not sure how well that's working because those things aren't reliable, especially if you're sitting in an electric vehicle in a large traffic, many hours of traffic, say in Shanghai or Beijing. Then I look at the stories here, and one of the top stories on oilprice.com, which is the best resource for oil and natural gas investors for free. It says oil markets are ignoring imminent production cuts by 3 OPEC plus members. According to OPEC, the entire overproduced volumes will be fully compensated for over the next 15 months through September 2025. So, I mean, it sounds like with the lower oil prices that OPEC is even considering further production cuts.
Yeah, they might. And I think they're going to defend $80 Brent. Actually, in EIA's short-term energy outlook report that just came out on September the 10th, EIA's forecast is that Brent is, by the end of this month, by the end of September, they expect Brent oil spot price to average $82 a barrel in Q4, and they expect it to average $84 a barrel in 2025, which would put WTI at about $80 a barrel. And if you look at their 4K. There's a little graph they show in that short-term energy outlook, and anybody, you can go to the EIA website and just put STEO, that short-term energy outlook. They call it the Steno report, and you put it there, and it's just like a little 2-page summary of where they think oil and gas prices are going to go. they're not the greatest forecaster of oil and gas prices, but at least and they have a lot of data. And one of the big spreadsheets of data they show is that, U.S. oil production is pretty much flat line. Actually, U.S. oil production has gone down from the December average. It's gone down in the first 6 months. So, we're not completing enough wells to really add more production in the U.S. right now.
And in that same report, and I'll attach a link to it below the interview in the information and description section, They are also saying that inventories are going to be substantially drawn down over the next couple months.
Yep. They've been predicting for 3 or 4 months that inventories would continue to fall through the first quarter of next year. Maybe they've come off of the beginning of next year a little bit, but it's tight. And in the physical market, on a days of consumption basis, U.S. and OECD petroleum inventories are below where they should be based on as measured on days of consumption.
And let me add there, you mentioned that you think that the oil price, the futures contract oil price, because physical supply and demand for oil is much different, I would say, than the oil futures contract price, similar to the gold market. And you're saying that there's motive there to make the inflation rate look lower and try to coax the Fed into cutting interest rates. I would also argue, I think there's games, and I think we saw this back in November 2023, at least a couple months prior to the November congressional elections in 2023. I thought the oil futures contract market, there was tons of dumping onto that market, paper price manipulation to try to knock the oil price down, to try to help the incumbent party in Congress for the November congressional elections back then. So I think we're seeing similar games now too, where the incumbent party in the White House is trying to knock the oil price back down. So the narrative is that the inflation is not as bad, even though that the incumbent party, the Democrats, tend to be anti-fossil fuel, at least publicly.
Yeah, I agree with you 100%. I think there are forces at work. And, when you think about it, oil is probably next to food the most important supply chain in the world. And it would be nice if we didn't have enough all these paper traders in the futures market trying to manipulate the price. If we just had the producers negotiating with the refiners on what the crude supply would be and what the price would be, it would be a lot more stable. See, before they really expanded, I'm old enough, I've been in the industry for over 40 years. I remember when it was a big deal if the price of oil moved 10 cents. It would be the same, the posted price would stay the same for months and, not do anything. Now you got these $1, $2, $3 swings on a day-to-day basis. Yesterday it was down $3. Today it's up $2. I mean, it's just crazy. And that's all just what you're seeing. The price, what people see of the oil price is the front month futures contract. And as you move further and further into the month, there can be some really wild swings as it approaches the expiration date.
Well, only a couple months ago, the oil price, the West Texas Intermediate price, was around $80. I mean, it's come down substantially, but I think it could be in the process of bottoming. Maybe after the election, they'll let the oil futures contract price rise again, and the supply-demand fundamentals will start to matter more.
Yeah, I mean, just if you do a one-year chart for oil, you'll see that we were in the last 12 months, we've been over $91, and we've been down to like 66 or the most recent low is the 1 year low. And so we've been like 65, 66. I think, like you said, it closed on Wednesday at 67.30. So anyway,
it's near the bottom. It's near the bottom of the range from what I remember. So
yeah. And I don't see it. If it goes much lower, you would see people cutting back their drilling programs. Well, and the one thing, because the U.S. is we're the number one oil producer in the world now, and we are very dependent on these shale plays. And the shale wells come on strong, and then they decline rapidly. And so you got to keep drilling new wells. And so if we cut back on drilling programs, you'll see the U.S. oil production drop pretty fast. And you had that in COVID. At the beginning of the COVID pandemic, we had guys slamming the brakes, shutting down all their rigs. Even if they had drilling commitments, they maybe would drill the wells but not complete them. Just put pipe in them and just leave them sitting there. And you're getting that with the gas wells. You had that this summer too. Then the production, then the supply and demand can balance very quickly because of the shale stuff falls off so quickly.
Are those DUCs, are those drilled uncompleted wells?
Yeah, they do. But the problem that you have in the natural gas side is all the big gas basins don't have enough pipelines. So one of the biggest problems is no matter how much gas demand there is in the U.S., we can only increase gas production maybe 4, 5 BCF per day. And they're saying demand growth is going to be 8 BCF per day in 2025. And we don't have enough. We're pipeline constrained in the Permian. We're pipeline constrained in Appalachia, the Marcellus and Utica, and even the Haynesville is approaching. The only major basin that's got some good pipeline access is South Texas, the Eagle Ford play, and because it's got direct access to Corpus Christi, where Cheniere has a big LNG export facility that's going to get bigger here in the next couple months.
But there's a lot of pipeline facilities, new pipelines that are planned or being expanded. So a good amount of them are under construction now. I don't know if they're going to be online in 6 months, but they'll be online in the next couple of years for sure.
Yeah, the Matterhorn pipeline. The EIA just reported that they expect it to be online by the end of September, and it's 2.5 BCF per day, and it's going from the central part of the Permian Basin. So it should help Permian Basin gas prices a little bit because, gas, a lot of the companies were really even having to pay people to take their gas out there. The gas price was just terrible that once you paid your gathering and processing fees, your net price was negative. So pretty big companies had negative gas prices.
Is that ONEOK or Enbridge or Energy Transfer Partners? From the Matterhorn pipeline, which company, or is it multiple?
I don't think. I don't know which one it is for sure. It's.
I think it was ONEOK. I think ONEOK is involved.
Maybe it
in
is.
One of the. I think it's
ONEOK.
ONEOK.
And ONEOK just announced a big acquisition. They're going to buy EnLink, take over control of EnLink, and they bought a big private deal. They announced like a $5.5 billion deal, and it really, the stock is it's one of our top performing stocks in our high yield income portfolio is ONEOK. That's symbol is OKE, an unbelievably strong company based in Tulsa. My office at Hess was right across the street from their office, which is one of the most beautiful buildings in Tulsa, by the way.
So for the Permian Basin, even though oil production did hit a record high recently, a lot of the wells, aren't they being more focused on natural gas? So a lot of the energy output that's coming out of the wells that have been drilled the last couple of years, they're more natural gas percentage on a percentage basis than oil, right? That's the common theme for the Permian wells now?
Yeah, that's called the gas to oil ratio. And as you produce the oil, it just naturally you get more gas. And I follow more than a dozen upstream companies that are producers in the Permian Basin, and they're all experiencing increasing gas to oil ratio. And the gas out there, you can't even get $1 for it. It's so oversupplied. So they need more pipelines for sure.
Okay, so for listeners out there, the reason you build a pipeline is you're taking it down to Texas or Louisiana to the liquefied natural gas export facilities or to an electrical utility company in Texas because they desperately need the gas because of all the people moving to Texas or the data centers or the liquefied natural gas export facilities. Dan and I were talking about this before we started recording. If you can take that cheap natural gas and you can move it on a pipeline to one of the liquefied natural gas export facilities in Texas or Louisiana, and then you can get that liquefied natural gas shipped to Europe or Asia, you can make immense profits.
Oh yeah, the profit margin is incredible. So gas today in the U.S., I think you gave the price $2.27. The gas price in Europe is like $12. In Asia, it's $14, and it only costs you about $2 to $2.50 to freeze it. You got to get it super cold so it liquefies, and then you can put it in a ship and to liquefy it and transport it to Europe. Maybe it cost you $2.50 to get it to Asia because they have to go through the Panama Canal. It's more expensive. It costs you about $3. But so the profit margin is gigantic. I mean, let's say all in your cost is $5, and you're getting $12 for it in Europe. I mean, I've never seen the profit margin on gas that high. So it depends.
And a long-term contract too. You could potentially, it's not just spot prices. You could potentially, if you sell it to utility companies, you could be selling it on a 10 or 20 year or even longer contract.
Yeah. All those big LNG facilities, export facilities that cost billions of dollars to build, they usually have got guaranteed buyers for the next 10 years. They won't build the thing until they got commitments. And the Japanese companies, Mitsubishi, I know, takes a lot of it. And there's big Asian companies, European, and the Europe market is desperate for gas supply because of this situation with Russia. And their gas storage is pretty full now. It's more than usual, but they don't have much gas storage that we do. So they counted consistently on a steady flow of gas from Russia. So that's kind of a misleading thing of how full their storage is. Because if they have a cold winter, and we're projected to have a cold winter in the eastern United States this year, and I think that Europe could have a cold winter too. If they do, they're going to be steady delivery of LNG gas to the market, and Asia's the same way.
Is the U.S. the only country compared to like Norway and Qatar that can actually increase liquefied natural gas export facility and the production amount fairly quickly?
Yeah, we're the biggest. We're the one that if our government would get out of the way, we could really jack it up. And that's one thing. If Trump gets elected, he'll probably fast track a lot of these facilities. But there's 4 or 5 of them that are already fully approved, and they're coming online no matter who's in the White House. And we're going to ramp up our LNG export capacity from 14 billion cubic feet a day in 2023. That by the end of 2025, we're going to have about 18 to 19. So we're adding another 5, 6, 7 BCF per day. And there's a pipeline that's going to be completed in the next 12 months. That's going to take another 1.5 BCF into Mexico. Mexico wants our West Texas gas for their power generation down there.
Isn't the liquefied natural gas export increases supposed to increase even more by 2028 to 2030? No. There's a lot of additional facilities planned. There was some recent deals. Tellurian, which was a small cap company, they were a pure play liquefied natural gas export facility company. Those shares crashed because they were planning on using cheap debt to build their liquefied natural gas export facility. They had all the permits in hand next to the Haynesville Shale there in Louisiana. And when the Fed raised interest rates, their cost of capital, they couldn't use debt anymore. Well, when the shares crashed, here comes in the larger oil and natural gas producer, Woodside Petroleum, the Australian company, and they want access to the cheap natural gas. They want to finish the liquefied natural gas export facility because they see all the profit potential that you just outlined. And Tellurian already has the facility under construction and the permits in hand. So this is a much larger company that could finish the project.
Yeah, it's pocket change to them. They'll get it done. And, if the permits are approved and everything, these things are cash flow machines as soon as they get on. So, I've seen forecasts that our export capacity could grow to like 30 to 40 BCF a day by 2030. So it's going to be steady growth. There's a little gap after 2025. I think there's nothing really scheduled to be completed in 2026. But then after that, there's just a whole list of LNG export facilities that are ready to be completed, that could be completed if they approve them to go forward.
Yeah, permitting is kind of the issue for a lot of that. So if you have the permits in hand, that's one thing. But if I remember correctly, when Biden first came in the White House, I thought he was promising to fast track more of these. And then the environmentalist lawyers went after him, his green energy environmental base. He was also promising discounted interest rates to build the liquefied natural gas export facilities for jobs. So he canceled that. It was just all talk. He didn't actually do it. But in terms of but in terms of the profits, Dan, I mean, there's rumors recently, the last 6 to 9 months, the Saudis are even thinking of investing in liquefied natural gas export facilities in Texas or Louisiana, buying either an entire project or like a 50% joint venture stake in them. So they're looking and seeing that the profits make a lot of sense too.
Oh yeah, I mean it's the cheapest and cleanest energy on Earth. I mean, six MCF of gas, which is $2.27 today. So multiply that by 6. What are you talking about? 13, 14, let's say $14 of gas has the same energy content as 1 barrel of oil. And, I can remember when the gas price was consistently 1/6 to 1/8 the price of oil. And if it ever got out of whack with that 1/6 to 1/8 ratio, it would quickly get back into it. We had $4 and $5, $6 gas back in the 80s. So, when the oil price was 30, So the real energy content for now, if you subtract out the transportation and everything, I think the highest our gas price could go would be about $8 or $9 an MCF. But that, there's talk too that, people bitch about gasoline prices, but if the natural gas price consistently went that high, you would see people's utility bills go through the roof, to heat their home and for electric power generation, because we're using so much more gas each year for electric power generation. It would send up electricity prices and home heating fuel prices through the roof. So I don't know, that's a problem. That would be a problem.
You're telling me about Texas and how Texas has enormous demand for new electrical utility inputs for things like natural gas, because I think in Texas, what they tried to do, wind and solar, and it hasn't worked so well for them. And there's been electricity shortages in a lot of parts of Texas for the last couple of years.
Yeah, the problem with wind and solar in Texas is a lot of times when it's like super cold, the wind doesn't blow that much. It's not like it's real windy down here all the time. And then in the winter, your solar isn't generating nearly as much electricity. And if we have like these ice storms and stuff, which we do occasionally get down here, then the windmills just stop. And that happened a few years ago, and we had serious power shortages because we do have quite a bit of wind power generation down here when it's all up and going. But there's a lot of talk about this distributed power generation where they could do these modular compressors and stuff and put them in and generators. And several of even the smaller companies that I follow are using their produced gas in the West Texas, which they were literally giving away to generate their own electricity. Riley Exploration Permian is now generating 100% of their electricity in their Texas oil field. They're generating themselves, and they're generating more than they need, and they're selling the surplus into the grid at a profit. So they turned a negative gas price into a big savings on their electricity and on the reliability of their grid. The problem in far west Texas, out in the Permian, is in the Delaware Basin and in southeastern New Mexico, is that they do have power outages on a regular basis.
Now, you mentioned before we started recording, you're telling me about this new small cap called Solaris Energy Infrastructure, and they have software and also hardware to improve their the grid there in Texas for the electrical energy. You want to tell my listeners about that a little bit more?
Yeah. Okay. Solaris Oilfield Infrastructure changed its name today on September the 11th. They changed their name to Solaris Energy Infrastructure. It trades as SEI, is this new trading symbol. Just did that on Wednesday the 11th. And I was introduced to this company by a professor up at SMU University up in Dallas that knew the engineers that started this. They are a highly respected oil field service company. They took over half the market share on handling frac sand at the well site. They have these vertical silos, and they have these, quick loading equipment and stuff like that. And they manage, and it's really saves companies a lot of money completing wells on having all their frac sand there. So they have just merged with a private company called Mobile Energy Rentals, and that merger is going to make them like number one in installing this they call it distributed power generation. And they're going to sell that and they're very highly respected. So all the big companies use them. And so their engineers are considered top shelf. And so I think they're going to be able to corner a good. And then Mobile Energy Rentals was already putting these things in for AI, for small AI data centers and stuff.
And we haven't even started building the next generation data centers. Yeah. Those are tens of billions of dollars each, and those are going to start construction in the next 12, 18, 24 months. Now, with Solaris Energy Infrastructure, it sounds like it has some decent prospects. Are they already profitable and their management?
It's a very profitable company. They have like almost no debt at all. I mean, just have trade payables. I don't think they have any interest-bearing debt. And they pay a dividend. They pay a dividend like 12 cents a quarter to 48 cents. I think that the stock's only like $10 or $12. Just check it out. And if your listeners want to, we did a profile on the company here recently. if they want to send me an email, you can put my contact information. I'll send them our profile update on it.
Okay,
I've been following it for 7 or 8 years since they went public. I've been following it.
Okay, I don't know what the market cap is. I didn't check before I started recording, but it sounds like an interesting small cap play that's already profitable, so they don't have to go and borrow debt to grow. That's the issue right now with cost of capital with a lot of these small companies. They cannot use debt. Their cost of capital is way too high.
Yeah, I do note here they did issue $325 million of new senior secured term loan to take it in, but they definitely have access to capital. They're very, very profitable and very, very well-respected oil field service company.
Okay, well, if they borrowed the senior secured debt and they can pay it off fairly quickly, that's not an issue. But the issue is like trying to build a liquefied natural gas export facility right now solely with debt. If you're a small cap company, that's like,
they're not doing that. I can tell you that they're not that big.
Now I want to transition. I want to ask you about mergers and acquisitions in the oil and natural gas space. Over $230 billion of deals the last 18 months. The last deal was Conoco, Phillips, and Marathon Oil. It seems that someone knew that Marathon Oil was going to get bought because their shares just kept going up and up and up the last 6 to 9 months. I want to get your thoughts on the valuations. Why do you think that there's so many deals lately in oil and natural gas for mergers and acquisitions?
Well, the one thing to think of, the Permian Basin is the most important oil field in the world, not just in the United States, in the world. And it has got development upside. It not only has horizontal development upside, it has vertical. There are places in the Delaware Basin that have over a dozen oil-bearing zones. If they have like 5,000 feet of oil-bearing zones in the Delaware Basin. And one company told me it's estimated there's over 30,000 development drilling locations in just the Delaware Basin part of it. So all those leases are leased. So you can't send landmen out to knock on doors and try to get ranchers to lease their minerals to you. There's hardly any open acreage. So the only way to get a foothold in the Permian is to buy out another company. And there's been a lot of these deals have been, private equity, PE funded, private companies that have sold, but there's also been, Permian Resources, merged with Earthstone, one of my top picks a couple of years ago. I love that company. It's a great deal. And they're continuing to do smaller acquisitions, but just in the last week or so, Diamondback, Energy, which is one of the biggest companies in the Permian, one of the top 5 operators in the Permian Basin. They just closed their merger with Endeavor, and it's a private company. In fact, the founder of Endeavor just died recently, and he made this deal with him before his death, obviously. And that is considered a mega merger. That pushes Diamondback's production to up to 800,000 BOE per day, and about 58% of that is crude oil, and another 20% or so is NGLs, high value NGLs. And they are the number one company in the Midland Basin. In the eastern part of the Permian is called the Midland Basin. And it looks really good, very profitable company. As soon as the merger closed, you got like 12 energy sector analysts upgrading the stock and stuff. And the stock's pulled back here with the oil price. So it's a really good entry. My valuation is like $225 a share. And I think it's like at $175 a share right now. And it pays a nice dividend, and it's got tremendous growth upside. And part of that deal is they have a controlled company, a subsidiary that's also public, called Viper Energy, and it is a minerals company, and they are going to drop down.
You mean a royalty? It's a natural gas royalty.
Yeah, natural gas royalty, not natural gas. This is pretty much all oil. This is an oil one, but it's all 100% Permian Basin company, and they're going to drop down a bunch of minerals in there. It's an $8 billion market cap company. Highly respected, good dividend, and a ton of growth. I think its revenues could grow by like 50% next year, and they pay out like 75% of their cash flow.
For our listeners out there, Dan has talked about Venom, which is a spinoff from Diamondback Energy, the oil and natural gas royalty play, in past interviews more extensively. There is a huge boom, a mergers and acquisitions boom in the oil and natural gas royalty plays. I think the industry consolidated into only a couple oil and natural gas royalty companies. I think Venom acquired 5 or 6 of them over the last couple of years, and Brigham Energy and another large one merged in the last 18 months as well.
Yeah, that's STR. Sitio is the name of it, and I just did a profile update on it, and it's the second largest one in our high yield income portfolio. It's only like a third of the size of Venom, but it has a higher dividend. It does have a lot of acreage in the Permian Basin and in the DJ Basin in Colorado.
Are those the two largest there? The two largest royalty oil and natural gas ones, Venom and Sitio?
They're the two largest that I follow. I think there's a Noble royalty that's bigger, and Blackstone has millions of acres, but it's heavily natural gas. Now, if you believe natural gas prices are going to go up, and I do, then Blackstone Minerals. Now, it is an MLP. It is a master limited partnership and pays a real nice dividend. It's got dividend yields like 10% now. It's got a very strong balance sheet, but it's more heavily weighted to natural gas.
Wasn't there also like a Texas Pacific Land Trust? Wasn't it a real estate investment trust, and they converted to a royalty in the last couple of years?
Yes. I don't follow that one very closely though.
Okay, so there's not that many. The space is getting consolidated, though. I think that's the point. And then we're seeing that overall with the deals. Would you say a lot of these deals, though, like Conoco but buying Marathon, it's not on valuation necessarily? You'd say it's mostly about like maintaining tier one acreage then and replacing reserves?
Yeah, these companies have to constantly keep rebuilding their drilling inventory. If they don't, I mean, they would be like a mining company that's depleting the ore in their copper mine or something. So they have to keep acquiring new drilling locations, and especially in these shale plays. I mean, they just have to keep drilling more and more wells each year. Now the well level economics, even at $65, $60, these are very profitable wells. I mean, a $60 oil price on most of these shale wells, the well will pay out in 1 year. And so they're churning the money pretty darn quick.
Well, it sounds like when Exxon said that they were going to slow down production growth, right, when they completed the Pioneer Natural Resources acquisition recently.
Yeah, a lot of times, when two big companies merge like that, especially because you got a lot of personnel that you got to integrate them into your land record system, into your personnel stuff. I did that for Hess. When I worked at Hess, I was over the E&P accounting, and I had like 200 people working for me out of land records, reporting to me also. And when you get these deals, you gotta put all that data into your thing. So a lot of times it'll slow down until you can get the back office stuff caught up, because you can't be running out there and getting a dozen more rigs and all the field people you got to hire. It's a pretty big deal on these kind of mergers.
Well, especially that's a $60+ billion deal for ExxonMobil, right? So that's going to take like at least 12 months, probably longer than that, for them to integrate all the personnel and Pioneer Natural Resources. Yeah,
I'm sure they hired a lot of their people too. But the good thing about the Diamondback Endeavor thing, those companies were literally right across the street from us and each other in Midland. They were eating lunch together all the time. So the personnel were very happy. And, so that was a private company. Now they're going to own stock in Diamondback, which pays a really nice dividend. So everybody was very, very happy. Both sides of that deal turned out to really approve of it. There was no problem getting that thing closed.
Do you think that there's going to be very large deals going forward, tens of billions of dollars? Or do you think that these players, a lot of them are going to take a break then, that they've done some deals lately, they're going to take a break and integrate them and focus on efficiency and paying off any debt that was used first? Yeah,
well, every time I think that it's going to slow down, another big giant deal is announced. ONEOK, a pipeline company that I followed closely, announced another like $6 billion acquisition here a couple of weeks ago. And I almost missed it. Somebody sent me the press release. I said, well, heck, I didn't expect that one at all. So you never know.
Well, they're on the prowl. I mean, like, if you have free cash flow, if you're a low cost producer and you have free cash flow, it makes sense to go and buy market share, go and buy a reserve replacement, especially if you can buy a producer at a cheap cash flow multiple right now.
Yeah, and some of these deals are done for a combination of cash and stock, and so if the seller believes that his assets are kind of undervalued, they're happy to take that stock, and especially if it's stock in a company that's highly liquid, they can trade it and they can collect dividends. Those deals get done, and that's how Earthstone built their company. Almost all their acquisitions were built on half debt and half stock, and then they got up to 100,000 barrels a day very quickly, actually. And over in about 2 or 3 years, they had that company up to 100,000 barrels a day. And then Permian Resources comes in and merges with them. And anybody that wanted a job kept their job with Permian Resources. And so everybody's loving that deal too.
I want to ask you about low-cost oil and natural gas producers that you cover in your Sweet 16. In the current environment we have, where in the short term, oil, at least maybe through the elections, oil could be weak. Natural gas, it sounds like over the next 6, 12, 18 months, natural gas prices could start to recover, but in the short term, they're weak. Who do you have are the lowest cost producers that you cover right now?
Well, I mean, they're all only have, operating expenses are maybe they can be profitable and cash flow positive, even if oil's like at $25 or $30. But they got to pay off the wells too. I mean, to be profitable, really profitable, you have to pay off the cost of the well. So they probably are break even in the $50 range or so. But I just updated all my third quarter forecasts, and I'm using $75 oil. And I did that because in the first part of the quarter, in July, oil was over $80 for almost all of July. So we're going to have the average will probably be $75 WTI. And a lot of these guys do hedge a whole bunch of their production anyway. So they're not that much impacted by short-term dips in the oil price or either way. And a lot of them had hedged a lot of their gas production, so they locked in like even $3 gas. So they're doing good. So I got them all profitable. And I'll tell you one I really like. I think I mentioned before was Crescent Energy, the company that merged with Silverbow. I really like them. It's trading below book value, which is insane. That thing looks really good. And what I like about them, they're in the Eagle Ford. They are the third largest producer in the Eagle Ford already. And the Eagle Ford does not have pipeline constraints. The Eagle Ford is further south. They can get their gas down to Corpus Christi. They can sell it to the LNG exporters down along the Gulf Coast. And they have no problem selling their oil. And it looks really good. And their current drilling program is just focused on oil-prone areas anyway. I like that one. On the gas side, EQT would be my number one pure gas play. They're number one in the Marcellus Utica up there in Appalachia. It looks really good. I like you've heard of Ovinta, right? That used to be in Canada.
The name sounds familiar. I mean, I was going to add for EQT, they're also talking about building a pipeline from the West Virginia Appalachian area, Marcellus Utica Shale, down here to Northern Virginia, because that's where all the data centers either are already or they're planning to build them under construction. I mean, there's an insanely large land boom here from Amazon, Microsoft, Google, and Meta. Insane.
Yeah, well, EQ, you hit the nail on the head there, buddy, because EQT is my number one play. If you believe this AI electricity demand thing is going to be so big, they are pursuing that. And they talk about it in their last quarterly report about how they're really going to try to be selling gas and making, and they're big. They're like 5 BCF a day. They're like the number one gas producer in Appalachia, in the United States even. And they're pure Appalachia, and they've got more pipeline access than any other company up there. And they're going to be making direct supply deals directly with the AI companies because they need to secure their own energy. So yeah, I like them, and the stock's cheap now because the gas is down. But I believe gas is going to get back to $3.50 next year. I truly believe that, and could go a lot higher if we have a colder than normal winter for a change. That could really help out. But that one looks good. But Ovinta used to be called Encana, and then they moved their office to Denver, and they got more of their production in the United States than they do in Canada. So they changed their name to Ovintiv. It's OVV. OVV is the symbol. It pays a decent dividend, very profitable. They got a good mixture between gas oil and NGLs in their production, and I like that one. And Permian Resources, I mentioned before, I like that. Another one trading below book value is a Canadian company called Veren, VEREN. It's the name of the company, but the symbol is VNV. VRN. I'm sorry, VRN on the Toronto Exchange, and I'm not sure what it trades at in the U.S. right now. I'm not looking at it, but that's a good one too, and the stock looks really cheap. Really cheap.
And I saw that you started coverage of Journey Energy, which is a stock that my friends own a lot of. Cuppy, hedge fund, oil and commodities hedge fund manager, Cuppy, Harris Kupperman, and then also Josh Young, who runs oil and energy hedge fund of publicly traded companies, Journey Energy, the Canadian company that also has an electrical utility component to it too.
Yeah, it does. It has three pretty big power generation facilities. It's turned its gas production, it's turning its gas production into electricity, and has basically doubled or tripled their cash flow from that. But they did have a somewhat disappointing second quarter. They reported a loss for the second quarter, but he did a webinar for us. I really like the CEO. It's more of a play on 2025, but I think it's going to be fine. And I think it could have a major, like this year, I got it generating just like 10 cents earnings per share. This stock is only like $2 or so. So about 10 cents earnings per share. I got their earnings per share going to 79 cents next year. So they're going to have a super low, forward PE ratio. If everything falls into place. They got into a joint venture with a very highly respected private company in the Duvernay Shale, and they own some very good. They partnered with them, and I don't know what the percentage. I think it's a 40 deal or something. And they got a lot of good acreage. They got a lot of running room in the heart of the Duvernay Shale play up there.
And if I remember correctly, the CEO has a track record of building companies that are undervalued. So he has a track record of this. This is not his first company. So he's built companies up, grown companies, and then sold them in the past.
Yeah. And I'll tell you, when you're investing in these small, especially these Canadian juniors, you're investing in the people. You're investing in the team. And I personally have made more money on Canadian juniors than I have on any other companies. I've got some stories where we made 4,000% on a little company called TransGlobe. I'm up about 1,000% on Hemisphere Energy, in play of 500%. There's some really good, really nice success stories up there, and they've really cleaned up their balance sheets. These companies are pretty much debt free now.
Are they doing mergers and acquisitions because the valuations and the cash flow multiples are so cheap?
Yeah, and you see more property deals up there. I haven't seen too many like big company mergers, but one thing, if the gas price in Canada would rebound at all, that would sure help, because some of these do produce a little bit of gas. But
the pipeline, the transnational pipeline, right, from Calgary, from Alberta to the coast in British Columbia, that one's come online, right? Or is it not fully ramped up?
That's the Trans Mountain pipeline. It's carrying oil. That's an oil pipeline. So that's really, really helped their oil price. The oil price from the first quarter to the second quarter, just because the differential improvement, because of that pipeline, they increased like $10 a barrel. Just the differential got them another $10 a barrel in Canadian up there, and that really helps. Now they are building 2 or 3 LNG export facilities themselves on the West Coast, and they're going to be shipping their gas to the Asian market. And when those get built, that should really stabilize their gas price up there. But there's a lot of oil and gas in Alberta. There's a lot of oil and gas. Saskatchewan up there. I really like the Canadian market, and they're trading on a deep discount to their valuations.
Yeah, they normally trade at huge discounts compared to American ones, especially when there was that huge differential there. Western Canadian Select, how there was I think at one point when I was an oil analyst, it was $20 a barrel, $20 a barrel was the routine price differential. But now with that pipeline coming online, that should drastically reduce.
Yeah, that really helped them. Hemisphere Energy, In Play Oil, and Surge Energy are all in my high yield income portfolio, and they all pay really nice dividends.
So actually, I was going to ask you about that, because if the Fed does start to cut interest rates and those short-term U.S. Treasuries are no longer attractive, which of the companies that you cover you think will have a safer dividend that they could keep on growing the dividend for dividend growth?
Yeah, the safest dividends are with the midstream companies. and I follow four of them that I like: Antero Midstream, Enbridge, which is a gigantic company, an 88 billion market cap. One Oak, of course, is one of our we're up over 100% on that stock since the first of the year. Plains All American looks very good, and that stock's cheap. And Plains All American, PAA, is an MLP, but their general partner trades as PAGP. It pays an identical dividend. The only thing it owns is interest in PAA, so it really has no other business. And it is the general partner, and it pays an identical dividend. And it is a C corp. So if you're, and listeners don't want to own MLPs and put up with the, waiting for a K1 or something, you can buy PAGP. And I think their dividend yields like 7.5%, 8%. So it's solid. And of course, the minerals, the royalty companies, I like all four of our minerals companies.
And it sounds like the growth opportunities for these dividend growth is also going to be the companies that are building these Permian Basin pipelines. So that's where it sounds like a lot of the growth potential is.
Yep. They look pretty good.
Yeah, so the Matterhorn one you mentioned, I think that's One Oak, but then I think Enbridge is also building pipelines, and then it's what I think Energy Transfer Partners as well is also building pipelines. And
there's like two or three of them. Yeah, they're going to be coming online in the next couple of years. So they're going to solve the pipeline takeaway capacity. It just takes time, and those pipelines are long. They go hundreds and hundreds of miles because Texas is big, and they got to get it down to the Houston area or the Gulf Coast. So it's a lot of pipe has to be laid.
Okay, so they're not moving the pipelines into Oklahoma for the Cushing, which is a natural gas storage. They want to move it to a liquefied natural gas export facility can.
Yeah, no, Cushing is oil storage. So the oil goes up to Cushing, a lot of it, but the gas all goes to the Gulf Coast.
Okay, so I think there's also a natural gas storage facility one in Oklahoma too, but the better price is to get it directly to a liquefied natural gas export facility.
Right, to get it or to get it down to Louisiana, so then you can get to the Henry Hub, and you can get it. There's like 8 big pipelines going to the Northeast there. So there's a huge hub of pipeline connection in Louisiana.
I get asked this a lot by natural gas bears that are warning about these hedges expiring. Are you worried about that with companies like EQT? So they're low-cost producers, but they have a lot of their production hedged at a hard price. Are you worried that their hedges could expire?
No. If they do, they'll just layer on more. And, if you look at the strip for natural gas, the prices are higher in the future. They can lock in higher prices today in the natural gas futures market. And they all think, every one of them I talk to are expecting gas prices to go up because gas supply is not going to be able to keep up with demand from these LNG export facilities. I'm telling you. Well, just the stuff we know that's going to be built, just the pipelines and the down to Mexico and the LNG facilities coming online. There's a shortage of about 4 or 5 BCF per day between the amount of demand, the amount of supply we can bring on because of the limitations in pipeline, and the demand. There's about a 4 BCF a day disconnect that demand's going to exceed supply. Now, today we have a surplus in gas storage, but it's going to be wiped out by the end of this year. That surplus is going to disappear by the end of December. I did a podcast on it last weekend, and I'm absolutely convinced that we're headed toward a deficit in storage. Within 6 months, we'll have a deficit in storage.
Yeah, I can't find the chart right now on the desktop on my laptop here that was saved, but you sent me the chart over with the liquefied natural gas export growth. This is the stuff that's already 100% permitted and under construction already. It's either under construction and permitted, or it's fully permitted and they are about to start construction. And that's not counting any of the additional projects. Let's say if Trump wins the election, that he's going to fast track probably with permits.
Yeah, I'll send you I got an updated slide on that in my podcast, and I'll send you my podcast slides.
Okay, so last question here. I want to ask you about commodities ratios because you brought that up before we started recording. You talked about the gold to oil ratio, and you said that was out of whack. Do you think that those things are going to be accurate? Because I would argue, you said that the oil price should be at $125 a barrel. An oil price at $125 a barrel in this economy, that would that would be like a tax for most people at this point.
Yeah, here's the thing. I think that ratio has been broken because you have such demand for gold as a storage of wealth. You have this fear of recession around the world. And I think central banks and stuff all over the world are wanting to hold gold now. So that's up there. I saw a projection that silver is going to follow that high, kind of catch on here pretty soon. And so I don't know if it'll get back. Historically, it was a 20-to-1. You would get gold selling for 20 times more than oil. So if gold's at 2,500, divide that number by 20, and you get $125 barrel oil. And historically, those traded in lockstep to each other with that 20-to-1 valuation. But maybe that's broken now because the demand for gold is so high because of these global recession fears and stuff.
Well, I think it's even worse than that. I think gold tonnage is replacing U.S. Treasuries as a reserve asset. So you're seeing this. So if you're like China or India, you're outside the G7, and you saw that 2 years ago, back in 2022, the U.S. basically froze, and now they're in the process of confiscating $300 billion of Russian reserve assets held in U.S. Treasuries. You don't want to risk that. You're seeing that if you piss off Washington, D.C., the policymakers here. So gold tonnage and having the tonnage delivered to your own country. So I think that's one of the new major demand drivers for gold now.
Yeah, let me tell you, we have members that are super bullish on gold, silver, copper, nickel. we have a lot of metal guys that are in our group.
Well, let me just tell you, man, that if energy and electricity prices, diesel prices, chemical prices, if those prices are heading higher, you can guarantee metals prices are going to go higher, because not only are the ore grades falling for gold and copper and silver over time, but then the energy cost to separate out, like basically for copper, Dan, you're moving 2,000 pounds of or 1 ton of worthless rock for about 20 pounds of copper. That's 1% copper.
Yeah, and they're having to go deeper and deeper to get it. And copper is the energy metal. You can't build a Tesla or anything. You have to have copper. You have to have a bunch of copper in a windmill and everything. And to transport the electricity, you have to have copper wire. There's no substitute for copper as far as transporting electricity. So
same thing for the data centers. So all these data centers that the tech companies are planning, I mean, like they're not talking about how like the amount of copper that's going to be required is going to be way, way more than anyone's projecting right now.
Yeah, I tell you, if I was heavily invested in AI stocks, I'd be very interested to know if their growth plans might be restrained by the fact that they're not going to be able to secure the electricity or the fuels they need to open those data centers. I think that could be a problem.
Well, I think you just nailed it on the head there, that's the way to play the future growth of these data centers, the next generation ones, and the capital expenditure boom is invest in the picks and shovels. So instead of like the gold mining analogy, going out and looking for the gold, hoping to find a gold nugget, you're looking for the picks and shovels. You're looking for the companies that have the copper, that have the nuclear power, that have the cheaper electricity, the natural gas, and the other materials that are going to build the data centers and maintain them, rather than trying to find the next software company with the killer app for artificial intelligence.
Yeah. Well, that's what's really got me kind of fired up about the Solaris energy infrastructure, is I think, because I know how highly respected these guys are. They came out of nowhere and they just gained an unbelievable amount of market share on well completions. And they are very highly respected. I mean, almost every upstream company that I follow uses these guys to complete their wells.
Oh, that's very interesting. Also, I think the other surprising growth sector now, and this is kind of a defensive play too, but now there's a growth component that no one was expecting until recently, and Warren Buffett's actually talking about this, are the electrical utility companies. So like a Dominion Energy here in Virginia, whatever your power company is in Texas, those companies now, they're going to have to invest in an absolutely insane amount of next generation data centers and electricity upgrades to handle all the electricity components. So there's going to be a lot of growth there, and they can probably charge higher prices.
Yeah. The energy transition, to me, it's not really to wind and solar. It's the energy transition is we're just wanting to transfer everything to electricity, right? Make everything run, make our lawnmowers run on electricity, make everything run on electricity. Well, you need copper, you need whatever,
well, the return on investment for wind and solar is zero or negative in many cases. It's a scam.
Yeah, I tell you what, between now and like 2 years ago, I don't hear about any wind deals anymore. Do you?
No, no,
you don't hear
it's
a
nuclear
word about
power.
wind farms. They're all dead. All those projects are dead.
Well,
And
there's been a huge one. There,
solar maybe.
So
Yeah,
China and India are still building solar panels and they're opening up giant solar farms. But yeah, a lot of other countries are not really doing that. What you're seeing now is like a nuclear renaissance, I would say, the
I
last
agree.
12
Yeah,
to. So the Davos crowd, and I think a lot of it's because of this nuclear power documentary that a Hollywood director released, and people finally saying, and then Europe had a ridiculous with the natural gas spike, where the average small business owner, they got hit with an insanely large increase in their electricity bill per month that a small business owner can't really afford. So then, like the politicians and the planners there are saying, we need to lock in a cheap electricity cost, or we're going to lose jobs and our economy is going to collapse.
right. And we see really the benefit of a membership in an Energy Perspectives group is the network. We have got a whole bunch of people with decades of experience in it. We have an active chat room thing called the forum. And today, some guys started talking about uranium and the nuclear market. I don't know anything about it, but we have people that know a lot about it. So it's just the networking is very valuable these days.
But I think we're going to see supply problems going forward for a lot of these key commodities. Nuclear
Oh, I
power,
do
there's
too.
going to be a lot
Yeah.
of demand, copper, and of course the regular energy. A lot of people, you saw. I'll give you an example. Google, and this is a great example that proves the case for all your energy plays. Google was telling people for the last, I don't know, 5 or 10 years, they're going to be net zero carbon emissions by 2030. Did you see what they released in the last 6 to 9 months on their quarterly earnings? They had to do a full 180 because of all their investments in artificial intelligence and data centers. They had to do a full 180 on their electricity and power usage.
Yeah. 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 It's interesting. Yeah, I think net zero is impossible.
Well, especially with it's impossible with if you're going to upgrade to next generation data centers and AI, because solar and wind and biofuels
Can't,
cannot handle
yeah.
baseload electricity when
Yeah.
the electricity demand is increasing by 10x. And that's what it looks like it is for searching with GPT or another artificial intelligence.
Yeah, and those data centers, they have to have 24/7 electricity. They cannot have power outages. So you can't be looking to wind and solar because they're unreliable. So you absolutely have to have nuclear, gas fired, or coal. But I don't see them building a bunch of coal. But I
Well,
think natural gas is going to have big demand.
that's funny because the one of the CEOs for the company that's building next generation data centers, he's talking publicly about how they still want to have like solar and wind as the primary sources for the electricity for the data centers, but he's leaving out how all the backups are all natural gas and
Right,
coal,
right, yeah,
and
yeah,
basically like the backup systems are like more important than because they'll have to shut down solar and wind if there's a weather problem.
yeah. Yeah, crazy. We have these electric utilities down here that they you can check a box and say you want all your electricity to be wind and solar. Well, guess what? The electricity in the wires that come to your house doesn't know where it's coming from. There's no way. There's no utility that just has wires with wind and solar on it. And
Is it the same
electricity.
price if you check the box, or are
Yeah,
you
no,
agreeing to pay like
yeah,
five or
I
ten
think
times?
you have to agree to pay a higher price or something because want to save the planet. So if you check that box, but I don't even. It's impossible. I mean, the electricity running through these big power lines is coming from all different sources. What the hell? I don't know how they're just
Well,
blind.
did you also see that new survey from people who have owned electric vehicles for years now? And I think it's over 50% said admitted in the survey that they want to switch back to regular cars or a hybrid
Mm,
because of all the inconveniences and problems with an electric vehicle, plugging it in, all the additional costs
yeah,
for
yeah.
electricity, unreliability, all those things.
Well, you look at how many car companies are dropping it completely now. Mm.
Well, wasn't Ford was losing $100,000 per electric
Per
vehicle?
truck. Yeah, per electric truck, I think it was like over $100,000 loss.
Well, unless
You're,
Washington D.C. is subsidizing the whole thing with bailout money or other types of like a Green New Deal or something like that. I mean, the auto companies, if they're not getting that government pork, they're going to cancel those programs if they're losing that type of money for each vehicle they produce.
yeah, unless we see electric, things you could plug your Tesla into on the highway, where they got like 200 of them at one spot. because that's how many it's going to take. We have these truck stops and Buc-ee's and stuff that literally have like 50 or 60 fuel pumps, and they're full, and there's cars waiting in line to get them because their gasoline's a little cheaper. Well, to replace that, you need 10 times more power, things to plug your Tesla into. Where's that all going to come from?
Yeah, there's videos of the lines at the charging stations for electric vehicles in California. They're insanely long. But did you see? I think it was either in the I think the new Inflation Reduction Act or in the energy or the infrastructure bill that the Biden administration passed in 2021 or 2022. They were supposed to spend many billions of dollars to build electric vehicle charging stations, and they spent $5 billion already. And I think they only built 8 charging stations so far, and they're all broken. Yeah, they're not
they're
working
all broken
properly.
all the time. Yeah, it's your government at work.
Well, I mean, I've been saying this for a while. I call ESG the energy spending grift from the government here. So all the large companies are heavily invested in it, but the return on investment when government allocates that capital to wind, solar, biofuels, electric vehicles, the return on investment is either zero if the company goes bankrupt quickly, or it's negative if the company needs a bailout.
Yeah, and just remember, electricity is not a primary energy source. You have to burn something to generate the electricity, or nuclear or hydro or something. But electricity is not a primary energy source. So we can make everything electricity, but something's got to generate that electricity. And that's just the bottom line. So
excellent point. And the other issue then is the electrical grid and transmitting the electricity, because that's inefficient too. So when you're transmitting the electricity from one point to another, the longer you go, the more inefficient it is.
Yeah, that's true.
Well, anyway. I want to thank you so much for your time today, Dan. If my listeners want to check out the Energy Prospectus group, how did they do so?
Yeah, just send an email to Energy Prospectus. That's one word, energyprospectus@gmail.com. And tell us you heard about us on your show. And I think Sabrina will give you a $100 discount on your first year of membership if you want to do that. But it's a very profitable sector. I said these companies are trading at single-digit PE ratios based on my forecast. So if it turns around here pretty quick, I think we got a lot of upside in the near term.
And let me add that in terms of value investors, and I never thought I would see this, I've seen value investors, traditional ones like a David Einhorn, a Warren Buffett, and the shares, the industry that they're buying shares of right now for value, they're buying oil and energy companies right now. So David Einhorn and Warren Buffett with Occidental Petroleum and others, that's the sector they're buying that they see value in.
Yep. Yeah, because it is. Anyway, all right, man. Hey, thanks a lot.